All right, everybody, welcome. Grab your notebooks and pull up a chair. Today's explainer takes the notoriously complex inner circle trader, or ICT, methodology and transforms it into a concrete step-by-step daily trading checklist. We're going to break down these high-level institutional concepts into a really clear sequence that you can follow every single morning.
So let's dive right in. As a mentor, I actually start every single one of my sessions by asking my students this exact question. Because when you look at a standard candlestick chart, well, you either see the trap or you fall right into it. Retail traders are constantly getting stopped out simply because they're trading against the underlying flow of the big banks and algorithms.
To survive out there, we literally have to rewire how we view price action. We have to read the chart through institutional eyes. We're not trying to guess or predict the market using those traditional retail patterns. Instead, we're following the undeniable footprints left behind by massive institutional volume. We let them make the first move, and then we ride their coattails.
To do that consistently, we need a system. So here is your chronological trading day checklist. 1. Mapping liquidity pools. 2. Navigating the kill zones. 3. Spotting institutional footprints. 4. The optimal trade entry. And 5. Precision stop-loss placement.
This is the overarching workflow you're going to execute from the exact moment you open up your trading terminal. You map your targets, you wait for those retail traders to be trapped, you verify the institutional footprints, and only then do you pull the trigger.
All right, phase 1, mapping your liquidity pools. Let's see how building this foundation maps the terrain before the trading day even begins. First things first, we have to identify our liquidity pools, which act as massive magnets for price. You're going to start on the daily time frame. You literally mark the previous day high. That's the absolute top wick of yesterday's daily candle. Then you mark the previous day low, the absolute bottom wick. Next, drop down your time frame and correctly mark the absolute highest high and lowest low printed during the Asian session, which, is typically this very tight accumulation range. Smart money intentionally draws price to these specific extremes to trigger retail stop losses and build their own massive positions. These are your targets.
Phase 2, navigating the kill zones. The absolutely crucial point here is patience.
Once those targets are marked, you don't just start clicking buttons. You sit on your hands. Time is just as important as price here. This timeline maps out our whole trading day. The Asian range sets the initial trap by accumulating orders. Then, right at 3 a.m. Eastern Time, the London kill zone opens. London is famous for manipulation. It usually creates the high or low of the entire day by sweeping that Asian liquidity. And then, we wait. We wait for the New York kill zone to execute the real, sustained institutional move.
Now notice our specific trigger for the New York session. At exactly 9 a.m. Eastern, an hourly candle opens. When it closes at 10 a.m., you mark the exact high and low of that specific reference candle. We are tracking this because we're waiting for a high probability breach of this candle's high or low during the New York kill zone. That signals the volume has officially arrived.
Okay, phase 3, spotting institutional footprints. The trap has been set, the kill zone is open. Now we keep our eyes peeled.
Listen closely here, guys, because this is where a lot of new traders fail. You have to distinguish a true shift from a fake out. A liquidity grab is merely a wick piercing a level before immediately reversing. It's just a trap designed to collect stops. A true market structure shift, however, requires a full-bodied candlestick closing completely beyond the previous structural high or low. It requires aggressive physical displacement on your standard candlestick chart. We're talking long, wide-range directional candles with almost no wicks.
And here is our mandatory requirement for a valid shift. That strong displacement must be so violent that it leaves behind a fair value gap. You physically draw this on your chart as the empty visual space between the wick of candle 1 and the wick of candle 3 in a 3-candle sequence. No fair value gap? Then there's no institutional footprint. It's really that simple.
Think of it like this. Picture displacement on your chart as an elephant jumping into a swimming pool. The elephant is the massive institutional volume, represented by those giant directional candles. The fair value gap? Well, that's the massive splash of water left behind by the impact. We never try to catch the elephant, we just wait to trade the splash.
Phase 4, the optimal trade entry. All right, let's get into the execution phase, where we find our sniper entry.
You need to sear these Fibonacci retracement percentages into your mind, 61.8% to 78.6%. This little pocket is what we call the optimal trade entry zone. We never, ever chase the impulsive move.
Instead, we wait for price to naturally retrace back into this specific mathematical discount before we execute.
Let's walk through a concrete case study together. Say it's 9:30 a.m., the New York Open. First, you watch price manipulate and sweep the London low liquidity pool. Boom, the trap is sprung. Then price surges violently upward, creating a full-bodied market structure shift and leaving that crucial fair value gap. You then take your Fibonacci tool, draw it from the very bottom of that surge to the very top. You set your limit order right where that fair value gap overlaps with your 61.8% to 78.6% optimal trade entry zone. Boom. You just traded perfectly in sync with the banks.
Finally, Phase 5, Precision Stop-Loss Placement. Because frankly, a perfect entry means absolutely nothing if your risk management is flawed.
To properly mitigate risk, you must place your stop-loss entirely outside the structural zones we just defined. Put it safely below the origin order block or tuck it just beyond the outer boundary of your fair value gap. And here is a rule you must never break. Always, always add a spread buffer. Add a pip or two of extra breathing room to account for the broker spread. There is literally nothing worse than being entirely right about the market direction but getting stopped out by a micro fluctuation in the spread.
So, as you close your terminal and log off your charts today, I want you to look in the mirror and ask yourself this final question. Tomorrow morning, when the market opens, will you have the iron discipline to strictly follow this checklist? Will you wait for the undeniable institutional footprints to form? Or will you let impatience turn you right back into the retail liquidity that the smart money feasts on? The blueprint is in your hands, but the discipline, well, that has to come from you. Keep studying, stick to the checklist, and I'll catch you in the next explainer.